Hello, thank you everyone for joining me. Today, we are going to be talking about credit score do's and don'ts, and I will be the one hosting the class today. My name is Kim. I am a financial wellness coach here at New Hampshire Federal Credit Union Centers for Finance and Education. We are also going to have this recorded for you, um, so we can run this class in the future. If you have any questions, feel free to go ahead and put those in the question tab. We are doing questions a little bit differently than we used to. Um, so a lot of people really don't want to interrupt the class. Like they might have questions and they don't want to interrupt. And so what we're doing now is if you go ahead and you put in the question in the questions tab, then what will happen is I'll actually get an email. Instead of it popping up on the screen, I will get an email. So what we're going to be doing is we'll be answering all the questions after the class is run. And when I send out a recap email on the class, I will have the answers of any questions that came in. Okay? So you don't have to worry. You're anonymous when you send in the questions. And also, you won't be disturbing the class, so you don't have to worry about that process either. I know we have a lot of wonderful people that join our educational webinars that just don't want to interrupt, and understandable, especially if we're going. And sometimes when the instructor's on a roll, you feel bad, but don't feel bad. Ask away, and we'll get all those questions answered. Okay. And now, also, what I'm going to have in the email is I'm going to have our information, our center's information, coaching information in the email, because what's going to happen is some of you, not all of you, but some of you might come here, get this education, and say, okay, I want to start this right away, but I'm going to need assistance. I really feel uncomfortable on exactly where to start. That's okay. We actually offer free one-on-one coaching that we're able to do that. We're able to set up coaching times with you to help you look at your situation, look at your goals, and connect them. What do we have to do today to be able to get over that bridge and reach those goals? Okay? So after having this education, we definitely have other classes too. If you wanted to continue your education, you most certainly can. But if you want help implementing that education, so taking that knowledge and implementing it into real life, just reach out to us. We can start the one-on-one coaching right away. Okay? And there's no set time frame. Typically, we'll usually do 3 meetings, and that's typically enough for some people. Sometimes people just need one meeting just to kind of get the outline of what they need to do, and they're like, okay, now that I have that outline, I am good. And then sometimes it may take all 3 meetings, may take a little bit more depending on the situation and the severity of it and what we're working on. Okay? And there's the first meeting's free, second meeting's free, third meeting's free. There's no charge for it, okay? So you don't have to worry about, because some people think that if they come to the initial meeting, that one's free, and then they have to pay going forward. And so we don't hear from them again because they're like, they don't want to deal with that. But it's not that we don't charge for this, okay? So, all right. So that being said, let's jump into credit score do's and don'ts, okay? There's going to be a lot of information on here for you guys. All right, so the first thing we want to look at is, first off, everyone's in a different financial position, okay? We might see 2 people that are similar, but it's still going to be different in some ways. So what we look at is, first off, we need to find out, where are you at? Not generalize, but exactly where are you at? What's your situation, okay? Do you need to improve your score, or are we looking to maintain your score? Uh, do you need your credit score in 6 months, 1 year, or longer? So if you're looking for a house and you want to build that up, usually the typical time frame for that is at least 2 years for not just your credit score, but savings and other aspects that go into buying a home. Are you looking to possibly need a vehicle in the next 6 months? So do we need to really focus on, short term versus long term? Okay. And if you do have a low score, what's bringing that down? It could be different things, and we're going to talk about all those different things that could be bringing that score down. Okay. Now, some people are unaware of how credit actually impacts your life. Year after year, it's actually impacting it a little bit more every year. So it used to be when credit cards really got going in the 50s, 60s, and 70s, it was something that really wasn't tied to you as a borrower at all. Okay. But as the decades and as we've really molded credit and having debt into our lives, that it's become normal for people to have debt, where it used to never be normal for people to have debt. Okay. Now they have this score, and a lot of the things that you do revolve around this score. These are some of them. Ability to get a loan. Okay. So that doesn't, and then you have the ability to get a good interest rate on the loan. So those are two different things. Buy a home or even rent an apartment. Usually, people that may have had a hard time purchasing a home due to their credit report and their credit score were then kind of set to be renters. Or if you were saving for a house like we were, we rented before we bought our home, just so we could make sure that we had a sufficient down payment and all that good stuff. But now, even renting an apartment, they're looking at your credit report. We had one coaching client that she was actually denied at 4 different places that she looked because of her credit score. And with the housing market the way it is, that's the last thing you want, is because you may have goofed and not paid something on time or not paid something at all. You don't want that to hinder you when you really need it. Okay? Buying a car, again, the ability to get loans. Get a job. This is something where it's become more prevalent. In finance, they will definitely check your credit report, because what they're doing is you're working with someone's money, right? And there's other jobs out there that look at your credit report, but I'm more familiar with the financial institution, so that's why I talk about it. The reason why they look at it is because someone who may not be able to manage their finances or hasn't known how to manage their finances, that may have a very poor looking credit report and therefore a low credit score, may be desperate. And people in desperate situations will do desperate things. Okay? And so when employers see a not so good credit report, that's the first thing they think of, is how would this affect our employee if we in fact hired them to do this job. And with finances, when you're dealing with somebody's finances, whether it be someone who has $1,000 or someone that has $1 million, that if you're desperate, there may be that chance that you do something desperate to help your situation. And so you might not be able to get a job due to your credit report. Okay? Getting married. This is another thing most people don't realize is that when you get married, your finances get married as well. Okay? And if I was really bad at my finances and I wanted to marry someone who did an amazing job and has like an 800 score and they paid everything on time, they made sure that they didn't overdo it with their debt. And then there's me who just went willy nilly and I didn't pay anything back and I'm very carefree and who cares? It doesn't hurt me, it hurts. Okay? We actually had a client that came in that was on her second fiance because the first one said unless she cleans it up, they're not getting married. She thought that was a joke. He did not think it was a joke, and therefore they separated. Second fiance said the same thing. And so she's like, uh-oh, this ain't no joke. And so she actually came to us to help her rebuild her credit and work on that credit report and to increase that credit score, because it impacts your life in so many ways that these fellows weren't willing to sacrifice that for you know and didn't want all of that to come onto them, which is understandable. I wouldn't. I worked hard for with my finances and being responsible for my finances. I had this conversation with my husband. Like, no, there's things that need to be taken care of before we join forces. It is one of those things where you might be like, that's silly, but it's one of those things that are very important. Okay. So let's look how credit actually works, right? Because we've been talking a lot about building it and what it affects. But now we need to know, okay, so great. We know that it affects this. I know I need to have a positive looking credit report. I know I need a good credit score, but now what does that mean? Right? Well, great to know that, but we need to know the other fact. So, how does credit work? So, you have to be at least 18 years of age or older to have your own line of credit. Okay? Credit cards, mortgages, student loans, personal loans, vehicle loans. Those are all items that report on your credit report. Number usually, we need to update this. With FICO, they tend to change it sometimes. So FICO actually goes between 350 and 850. But the reason why we have 450 on here is because usually we don't see anything under that. If it's under under 500, usually it's around the 450 mark. And I've seen one under 450. And usually if you don't have anything reporting on your credit report, it will just say insufficient credit history. So it actually can't even give you a score. Okay. Rent, cell phones, utilities are not typically included on your credit report unless you don't pay them. And then they go into what we call collection accounts. The merchant writes you off and sells that to a collection agency, and then a collection agency will try and contact you. The collection accounts show up on your credit report. So even though the positive, if you paid for those, it doesn't show up. But once you stop paying for those, they show up. And this is where a lot of people get a little disconnected because it doesn't show up while you're paying them. That they don't realize that if they stop paying it, it's going to show up. And it's going to show up in a very bad way. Okay. And so along with collection accounts, and they also show bankruptcies. and they will stay out there for at least 7 years. Some bankruptcies, depending on which one you file, will actually stay on your credit report for 10 years. Okay. And that may hinder lending decisions as well. So we usually try and avoid bankruptcy if we can. Okay. Now, when we talk about loans, and we were talking about, vehicle loans, mortgage loans, even credit cards. So the main way financial institutions will kind of put you on the scale, and we have a scale in a couple of slides, which kind of shows you an example of this. But it's called risk-based lending, and this is what most financial institutions do, including us. So we use your credit score to set an interest rate, depending on what your score is, and we'll talk more in the next slide of what encompasses. In the next couple of slides, we'll talk about what encompasses that credit score. Okay, so that will set your interest rate. So the higher the score, which is better, the lower the interest rate, which is better. Okay, so better score, better rate. The lower your score, the higher the rate, which is not good. We don't want the higher rate. Maybe if it was a savings account, yes, but if we're paying the rate, we don't want a higher rate. Okay. And so banks, credit unions, car dealerships, when you're getting a loan, maybe if you go to Toyota or Ford and you're like Toyota Financial or Ford, and you get financing through them, they all use the risk-based lending. Okay, so what this I want to make you aware of is if you're looking for a car and they might advertise as low as 6% for a vehicle loan, that's for the cream of the crop. As low as means that's the best rate for the people who have the best score. So that's why when you go in, you want to verify whereabouts you are, whereabouts your credit score is. We'll talk a little bit about that later, how you can kind of do that research ahead of time to get kind of an idea of where you are. Okay. All right. So the credit report and the credit score. So the credit report is the actual kind of data of your obligations. Okay. So the credit report will have all your identifying information on it. But then it also has the information of the merchants that you have signed obligations for, whether it be a credit card where you signed on the line to have that credit card, auto loan, a personal loan, a student loan. It will have that on there. Okay. And for each obligation, so for each merchant, let's say I did financing with Toyota Financial, it will show up on my credit report as Toyota Financial. It will show how much I borrowed, when I took that loan out, what's my minimum payment, the balance that's due, and then it shows how I've been paying that obligation. So sometimes you'll see paid as agreed, which means you've been on time. You might see check marks. You might see green check marks. You might see the number 1. That all means paid on time. Okay, and we'll talk about that in a couple of slides of what helps your score and what doesn't. Okay, the credit score is actually based on that data that's entered for each merchant. And so what they look at is they look at the amount of credit that you have available, the amount of money you owe on that particular debt. They'll look and see what your payments look like, how long it has been open for. So your credit score is based on all that data that is put on that credit report. All right. So that's where they tie it. So when we were talking earlier about kind of taking a peek and seeing where you are, these are the big boys that most people will have or get access to. It's Credit Karma, Credit Sesame, and Credit Wise. Credit Wise is a Capital One product, but you do not need to have a Capital One card to be able to use Credit Wise. Okay. So they do credit monitoring, which can help keep track of your credit score to work towards pulling yourself out of debt. But also will tell you if you've had any new inquiries. So it helps also identify if there's any possible identity fraud. Okay. And also what will happen is they'll tell you how your credit score is looking. And if it goes up, if it goes down, and what were the factors that caused that positive or negative movement. Now, what I usually like to tell people is sometimes when they do give those options, like examples of what could improve or what made your score go down, is it tends to be more general information instead of some of them are very general and not pertaining to you per se. So, for instance, we had somebody that came to us that had collections on their account, but one of these told them that, oh, if you open up another credit card, that will help your score. We will see that in later slides that if you have collections on there, I don't care what you do, you need to take care of those first because those hit your score hard. Okay. And we'll talk about that a little bit more when we talk about the percentages on what goes into your score. So again, what goes into your info, we touched base on this, and this is what will show up on that Credit Karma, Credit Sesame, Credit Wise. It'll show all this information. It shows up differently. Each layout is a little bit different, but it all has the same information because this is the information that is gathered to build your score. Okay. Another place that you can actually look at your credit reports is www.annualcreditreport.com. All right. So typically it was you can pull all three bills once a year. With COVID, they actually switched that so you could actually pull them multiple times within the year. And so I just have to double check and see if that has changed, or I haven't got any notification as far as what they were going to be going back to. But at least you can pull them and you can see everything that's reporting, and you'll see all three credit reports. Usually on those apps, you usually have access to one credit reporting agencies. There's the three. There's the TransUnion, there's the Equifax, and Experian. Okay. And so with annualcreditreport.com, you can pull all three once a year. And you can see, because certain things report on certain ones. And usually when you're looking for a vehicle loan or a personal loan, usually financial institutions will always be using the TransUnion. Okay, because that's typically where the vehicle loans and those type of financial items are posted, is on the TransUnion. Okay. So as we talked about risk-based lending, we talked about how there's tiers. Okay. We talked about if you see an ad that says as low as 6%, that is for the top tier. And this is how they kind of break it down. Every financial institution is a little bit different. They all don't go by this model. So it could be one place could have you could be in a great evaluation if you had like a 740 or higher. So but they all have this type of tiered look, okay? And as you can see, the higher the score, the better evaluation you get from a lending officer. So if you're looking to get a loan and you're in the high 700s, what this shows is it demonstrates to the lending officer that you are a great borrower, okay? Which means you stick to the contract. The contract that you signed saying that you were going to pay this amount over this amount of time each month on this date, you follow it. Okay. That's what lenders like to see because that will bring down the risk value. Because if you're an exceptional borrower and you are great at paying things on time, then that's why you get the better interest rate because you have a lower risk factor. Okay. As the score goes down, you can see so does the evaluation from the lending team. So as you get lower, and if you're in the bad category, we usually like to say that this is the category that we can work on. Your score with this, the lenders consider you an extremely risky borrower because to get down to that point, there needs to be multiple things happening, negative multiple things on your credit report. Okay? And so, because you're a risky borrower and they might see late payments, they might be like, oh, we don't know if this person is going to pay us back. So, they're going to have a higher interest rate because we can't trust them, ultimately, is what it comes down to because it's very risky. Okay? Now, this is what goes on in your score. Okay? So, we were saying that the score is based on the data on that credit report. You are going to see that payment history is 35%. That is the biggest chunk that is used to create your score. What that means is that you pay your stuff on time. That's it. So the biggest part of your score is just paying back your stuff that you agree to pay back. Okay? Next one, amount owed. This one looks at how much debt you have and how much you owe. For instance, like if you have a credit card and you have an available balance of, let's say, $1,000, and you only use it for gas during the month, and you only put $200 on that card, and then you pay it off. That's going to look good, right? Because you're staying under a 30% of that card. 30% would be $300. So if you're keeping that balance under that 30%, you're doing fantastic. And the algorithm puts up green lights saying this person is responsible, this person is able to use the card and pay it off or keep it under a certain amount. So it's telling them that you're able to stay within your budget and that you're reasonable with finances. If you go over that 30%, so if you have the $1,000 card and you put $500 on it, it starts sending up red flags, right? The reason for that is the algorithm is saying something's happening where this person is using more of their credit than they should be. So something's happening where they can't manage their finances at home. Now, this happens even if you pay off your card every month because we don't know when that particular merchant sends in the information into the credit bureaus. I had one person that had $1,000 limit. They were putting $800 worth of stuff on the card. They were paying it off every month because they still budgeted, but they wanted to get points. And so what happened was that the credit reporting agent, when we pulled their credit report, we were able to see that I'm like, oh, you don't want to go, because they told me that they keep a zero balance on their credit card. I'm like, well, that's if you do that, you shouldn't be having a lower score. So when I pulled their credit report, I saw on that card, I'm like, it shows that you have $800 on that card. I thought you said you don't use it, that you keep a zero balance on it. They're like, oh, no, 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 no. I use it, but I pay it off every month. I'm like, no, 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 no. So this is what we need to do. You need to not put everything on that card. Or when you use it, at the end of the week, make a payment. And then that way you're making 4 payments to this card over the month and you're never going over that 30%. I'm like, because even if you go over that 30% and you paid off, you don't know when they're reporting. So in this person's case, they were reporting when it was at its highest. And so she was having red flags and it was actually hurting her score rather than helping it. Okay. Next, we have length of credit history. So the longer you have stuff reporting on your report, the better. New credit is considered anything that has been opened in the last 2 years. And the reason why this is on here is because if you open up a lot of new stuff at once, what happens is there's red flags start going up that something's happening that you can't afford, and so you're opening up all this new credit. So if you're trying to build your credit, opening up a bunch of new stuff isn't going to help. Opening up one thing may help. Opening up 2 things may help, but other than that, do not go crazy, okay? Types of credit used. Types of credit are, we have credit cards that are considered revolving credit, right? You have a set amount, you can use, pay it off, use, paid off, use, paid off. So it's revolving. It's like a door. When you use it, you can pay it off, and then you can use it again. And then you have installment loans. Installment loans are more like the personal loan, vehicle loan, mortgage. You have a set start date, you have a set end date, and you have a payment. Boom, 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 boom. And you know your payments are going to be done at this time. There's no revolving. You don't get more credit to use, okay? So these are the credit bureaus that they go ahead and report on. We like to have you look at all 3 because not everything gets reported to just one. And again, this helps protect against identity theft too. Okay. So that's the first do. Know your score by using one of those applications, and then know what's on your credit reports. Another do. Pay your bills on time. Again, this is the biggest thing, the biggest percentage of your score, and going to help you tremendously. Don't let your credit card balance go over the limit. That's huge. That lets your uh, score drop dramatically. And what that is if you have $1,000 limit and you use the full $1,000, and then all of a sudden the interest gets put on it, but you're only paying but you're only paying the minimum payment. That minimum payment may not cover the interest alone. Never mind the principal. Okay? And so what happens is, let's say your interest was $100, but your minimum payment $75, and you have your card maxed out to $1,000. So it's at $1,000. You get the $75 hit or the $100 hit of interest, and then you make your $75 payment. Well, now your card is at $1,025 that you owe. And right then, it's like, something's happening. And that actually will lower your score dramatically. Okay? And we also talked about not letting your credit balances get too high. Remember, that 30% rule. Do not go over 30%. All right. Do keep track of your spending. So I love budgeting. My husband and I, other than the house, we're debt free. And well, we do have one other debt. We have we got a washer, dryer, and dishwasher, and so we have 0% for the first 12 months. So we're already, because we budgeted, so we're going to be done at the 11 month mark just to be on the safe side. But we budget, and for instance, when we go out and we're looking to buy something, even my husband, he has a credit card for his business account because he does a lot of stuff with that, but he also budgeted for his business. So he actually still has an expense account. He puts everything on the credit card because of it's easier to keep track of for him for tax season, but also he gets points for his business. But he also has that expense account in his business savings. So when he spends money on the credit card, he goes to his expense save and pays that rate off, right? He's still keeping track of his spending. Don't add your credit cards to Amazon, Instacart, PayPal, Apple Pay. Now you might say, but that's convenient. Yes, that's the issue. Merchants know that first off, using a card, you are apt to spend like 200% more than you were willing to spend if you had cash, right? So, just shopping online, you're more apt to spend more money. Second, if you do not have time to think about your purchase, you're going to make purchases that you normally wouldn't make if you were in the store, even if you were paying with your card. And so what you want to do is if you have a hard time and you're a shopper and you use your cards a lot, I recommend do not add your card to any of these, because what's going to happen is if you find something on Amazon and you have to go through and you have to enter in your card information, it's giving your brain time to actually think about this purchase and to actually make a thought on whether you actually need this item or if you thought it was just nice and you wanted it. Okay? So, especially with the one click, that is dangerous for people, right? Even PayPal, if you go through and you just hit PayPal, PayPal has all your information. You can just go, yep, I'm paying with PayPal, boom, it's done. Okay, so you want to make it harder for yourself, especially if credit cards are kind of the reason why you're having trouble. Okay, we want to make it difficult to use them. Okay, do not ignore collection debts. So these are some of the biggest reasons people have bad scores. This and paying, because ultimately, the 35% of your payment history. Well, this shows that you didn't pay it at all. So this is part of your payment history if you have anything under collections. And it stays on your report in collections for 7 years. So some people are like, I'm just going to wait till it falls off. I say, well, I will guarantee that you're going to need something in the next 7 years that's going to involve a loan of some sort. And if you have these collections on here, I bet that you're not going to have a good score, not even close. And then if you do get someone to lend you money, you're going to be the highest risk. You're going to have the highest interest rate, and it's not going to be worth it. It would have been worth just paying them off, which comes to our next slide, which is a do. See about payment plans or settlement offers, but get those collections off of your credit report. Most people don't realize that you can call up the collection agencies and see if they'll settle with you. Some will also make out payment plans. So they are willing to work with you. Others are not. So if you have multiple collections, I would say definitely work with the people who are willing to work with you first. Okay? But yeah, get those off of there. Experian Boost is a positive thing. So remember how I said rent, utilities, phone usually do not go on your credit reports unless they're in collections and then they show up? Well, with Experian Boost, you can actually get credit for those items, but only for the positive things, which is great. So if you miss a bill or miss something, it won't report on there. Just report the good stuff, which can help. In the beginning of the webinar, I mentioned that financial institutions usually choose TransUnion. But when you're looking at a home, they actually pull all three and they look at all three. So if you're able to boost your Experian report, that's going to benefit you for when you're looking for a home. Okay? Another thing that we offer to help if you, because as we mentioned in the beginning, you might have some negative things reporting on your credit report, or you just might have a lack of items reporting on your credit report, and that's why you might have a low to no score. I love the Credit Builder loan, and because what it's like is it's like a savings account on steroids almost. So what I like to tell people is imagine a piggy bank, right? You're like, I want to save $1,000. Perfect. We take out a big piggy bank. We put your name on it. This is just for thought process, but we don't actually give you piggy banks. Just want to tell you that. Put your name on it. Say $1,000. You pay us a certain amount of money in a 12-month period of time. We break that down into 12 payments. So usually it comes out to, I believe, around like $84. Some money goes to the interest, but then the biggest chunk goes into your piggy bank. So each month you make a payment, little goes to interest, bunch goes into the piggy bank. At the end of 12 months, once you've paid in that full $1,000 plus the interest, we take a hammer, we smash that piggy bank, and we put it in your savings account. You're like, oh, cool. But the best thing about it is every time you make a payment, that actually reports on your credit report because it's technically a loan, right? Even though you're really just paying yourself. It's a loan. So instead of just saving and put money away for something, if you don't have anything reporting on your credit report, or you might have just paid off your collections and now you just want to have an extra boost in having it look good, having that Credit Builder loan is going to be huge for you. Okay? So that is usually something that we do with a lot of our clients that are trying to build their score back up. Next, you don't keep a balance on your credit card. That doesn't help your score, okay? Getting another credit line could help your score, but having a balance will not. So that's why we usually say you tag team. If you're going to use a credit card, I still want you to have a budget. I still want you to plan on spending. So let's say you use your credit card for gas. I still want to see a gas item in your budget saying, I am going to be paying $40 a week for gas. That's going to be coming out of my income. But instead, what you do is you use your credit card and then you pay that $40 to your credit card rather than paying it to the gas attendant. Okay? So if you're going to use your card, still budget for whatever you're going to use it for. Make sure that's on your budget. And don't carry a balance, because if you carry a balance, that's when you start getting hit with the interest. So it's kind of pointless, right? And it doesn't help your score if you carry a balance. This one's going to be big, especially if you have cards that are above that 30%. You want to definitely lower those. So lower your debts, right? If you're able to pay things off, wonderful. So for the longest time, I have a Macy's credit card. I always forget about it because I don't use it only until Christmas. I love shopping at Macy's at Christmas. I go to the big one down at the Burlington Mall. And what I'll do is we still save for Christmas all year long. And what we do is I'll bring my card because I usually get a 20 to 30% off on already clearanced items. And so what I'll do is I'll put it on the card because I want to get that extra 30% off. And then what we'll do is right then and there, I'll take out my cash and I'll pay off my card. And so I only use that card once a year. If we do Macy's, the last couple of years we haven't. But I do that. And I told everyone, I'm like, I had a car loan. My last car loan was probably 6 years ago that I paid it off. And I only had that one card, and my that I never used throughout the year except for that one day, and then I'd pay it off right then and there. And my credit score was 800. So when people say you need a bunch of things and you need this and you don't need that, you don't. You just need to know, what's causing you to have a good score, what's causing you to have a bad score. Okay. Making a plan to lower debt. So definitely loans, and there's different ways that we can do that, especially with credit cards. If you have credit cards you have multiple cards over that 30% thing, sometimes what people will like to do is to actually do a debt consolidation and take all that credit card debt and put it into a personal loan. Because what you're doing is you're taking the balance off the credit cards, you're putting it into a personal loan, which is now all that's going from a revolving to an installment loan. So you'll have a start date, you'll have an end date. And then you free up your amount owed on your credit cards, which will help increase your score. So there's different things that we can do. Sometimes that is not plausible because of how, the credit report might look. So in that case, you come see us, we see what different types of options we have. And one of the options is we might need to holistically pay down your debt. Like actually saying, okay, because you can't get a loan, this is how we need to start this process. Be focused about it and work at it at that point. Okay. And to tie in what I was just saying, so you want to explore other debt options. Like we were just talking about the debt consolidation loan. You also have mortgage refinances that people will do if they have a lot of debt. They'll refinance their mortgage if they have equity and pay off their debts. Some people will take out an equity loan, do the same thing. This actually works even for vehicles. So let's say if you got your vehicle maybe like 6 months ago to a year ago, and you were in a bad shape then, but you're in a much better shape now, you can actually refinance your vehicle, right? That's an option. And you might, depending on where you are, where you were, you may be able to get a lower interest rate, which may cut your payments by, hundreds of dollars, okay, depending on what that looks like. Most people really gravitate to the equity loan. So we're going to talk a little bit more about the equity loan benefits. So right now, equity, it's a good time to have equity. Most people have equity if they've had their home for a few years now, especially if you bought before 2021. The values of homes skyrocketed. And so a lot of people have like crazy equity in their homes right now. But what can happen is, so what that is it's like a second mortgage, right? If your house is worth $400,000 and you owe $200,000, that means you have $200,000 worth of equity. You own that $200,000, and so what people will do is they'll open up a home equity line. Not saying for that full $200,000 that you have equity on, but some people like to do $50,000 or $100,000 to cover if any expenses come up. They'll do that. But they can use that money for anything they want. So if they open up a home equity loan for let's say $50,000, and they wanted to pay down $20,000 worth of debt, credit card debt. They could use that money for whatever they want. Okay, typically with a home equity line, there's better interest rates than the debt instruments. So that's something that people are looking more into. So you have and you have two different options when it comes to home equity loans. So you have the home equity loan, which is one lump sum. So if you're taking out $50,000, you actually take $50,000 out, and you have that money to do with it, and you start making payments right away. If you do a line of credit, it's like a credit card on your home, right? Or a debit card on your home. So you have the $50,000 available to you. Let's say you use $10,000 of it to work on your roof. Well, you don't make any payments until you use some of it, and that's with the line of credit. So if you use the $10,000, that's when you have payments to pay that back. And so you only make payments, you only have that available if you want to use it. So a lot of people like to do the line of credit because they have it there more for a safety net. Okay. Next, don't fall for the minimum payment trap. As I mentioned before, this can actually get you into trouble, especially if that minimum payment is not even covering the interest that's getting put on the card every month. Okay. So, and for this one, you can see if you do the minimum payment, it's going to take 17 years. And you're actually, instead of your balance paying off a balance of, let's say, $2,300, you're now paying a total of $5,400. Okay, so that's $3,100. So you'd pay more in interest than you actually do your balance. So don't do that. And we can work on you as if you want to do coaching and set up a payment plan to pay those down faster. Okay. And our last slide is, do not close your oldest trade line. Remember, that was 15% of your score. So even if you're not using it, like me with the Macy's card, I just use it once a year. And it doesn't get shut down because I use it once a year sometimes. And usually it's with that one, I think it's every couple of years. If you don't use it, then they'll close it. So even then, if I miss a year of using it at Christmas, and then I use it the next year. And again, like I said, I'll say that I don't have any credit cards on some of these webinars because I totally forget I have it until I think about Christmas, and I'm like, oh yeah, I do have one. So that's probably like one of my oldest ones. I just, just do it and go Christmas shopping, and it looks good. So that is what some of the do's and don'ts, and definitely, again, this is generalization, right? So everybody, as we said in the beginning of this webinar, is a little bit different, and therefore your approach to increasing your credit score and getting your finances in a better way might be slightly different than the next person. And so that's why sometimes we really recommend coming in person and doing that coaching, because then we're really able to tailor this to you in your financial institution. Okay? All right. Well, thank you so much for joining me. Again, we're going to send out an email with our information on there. Our phone number is at the bottom of the screen. It's 603-224-7731, extension 330. That goes right to the center. We also have our email, which is centerfe, so F as in Frank, E as in Echo, centerfe at the @ symbol, nhfcu.org. Okay, and that will come to the center. All right. Well, thank you so much, everyone, for joining me. And I hope you got a lot out of this. And if you have any questions, again, those will be coming to me in email form. And when I send out the recap email, I will have those questions and those answers for you. Thank you so much, and I hope you have yourself a wonderful day. Bye bye.